Time value of money. Whatever I can buy today, let's say at $10, 3 years down the line, there is no guarantee that I could buy the same product and the same quantity for the same $10. Inflation comes into picture. Okay, the inflation comes into picture. Maybe the demand supply could be a concern as well. That could also spike up the cost. So it's always uncertain. So whatever you have right now, the amount in hand right now is worth much more than what you could, for the same amount 5 years down the line or 3 years down the line. So let's say you have invested $10,000, or you have parked your money with, you purchased some government bonds, or let's say a simple bank deposit at annual rate of 3%. Okay, for 5 years. 5 years. Okay. By the way, here. Okay, yeah, that's fine. Years, rate, amount. I parked my money with the bank for $10,000 for 5 years. What is the amount that I would receive after 5 years? Amount after term. This is my present value. This is my rate of return. Term is 5 years. So what I need to get is future value. FV is a function here in Excel that we have. First, now these jargons or these terminologies that you see over here, they are generally standard across financial calculators. Whether you buy Texas Instrument, HP, or Casio, or any other brand, mostly the financial calculators have the same jargon. Slight variance probably. Instead of rate, some might have it as I by Y, that is interest per year. So here, what is the rate? Annual rate of interest of 3%. N per, that's number of years. So in this case, it's 5 years. PMT is 0. Are you getting any consistent returns at periodic intervals? No, you're not getting that. In bond markets, we call it as coupon value or coupon amount. We are not getting that here. We are directly getting a complete lump sum amount towards the end of the tenure. So PV is the present value. I am giving it to the bank. That's a cash outflow as of today. So I use a minus sign and link it to this amount. I close bracket. What do I have? I invested $10,000 at the rate of 3% per annum for 5 years. After 5 years, I get 11,592.74. Okay. Now consider this. Let's say 5 years down the line, I need to have 11,592 in my pocket. Okay. And I'm expecting the rate of return to be at 3% again for 5 years. This is my plan. First part was, I don't care what I'll receive later on, but at least today I have 10,000 in my pockets and I need to invest it somewhere or park it with the bank in the name of deposit at these terms. And then whatever I get, it's fine. Here, my target is the investment amount, not the returns. But let's say here, my returns are my target and the terms remain the same. Now, what will be the amount that I'm supposed to invest today? So that means I have a future value and I need my present value. So again, I use a FV function. Rate is 3%. We mentioned that consistently. I inquire with the bank and they say, if you park your money with us for 5 years, we'll give you a rate of return of 3%. And I have a target goal. Let's say I need to go on a vacation and the total cost for my vacation is this much, 11,592.74. Now, in order to get this, meet this target, how much should I invest as of today, considering these are the terms of the bank? N per is 5 years. PMT 0. There is no fixed amount that I'm depositing at regular intervals. It's one lump sum single shot payment at the start. PV. Oh, my bad. It should have been a PV formula, not FV. We are trying to find out the present value and not the future value. So future value is this. So I'll refer to this, close the brackets. and $10,000. It's showing negative, indicating that it's a cash outflow. So in order to earn this much, today I need to invest this much. Now, the rate over here, this was my interest rate. In bank's terms, this is still an interest rate, but in valuation terms, this is now my discount rate. This is my discount rate. That means whatever value I'm expecting in the future, I want to see what is it worth as of today. I need to discount it back to today's date or as of today, the future value. 5 years later, I would receive this amount, but what is it worth today? $10,000. How did I do that? I discounted it at 3%. So the terms changed. The values were same. The terms of the banks are exactly the same. It's just the perception or the angle from which you're viewing this slightly differs. And accordingly, your narrative for subsequent evaluations or analysis go in that direction. So this becomes my discount rate. Okay, the rate of return at which I'm expecting it. Now, this is one approach of looking at my discount rate. Let's say I have a property which is worth $200,000. I have a property, maybe my apartment or something else, a land, parcel of land or something, a property which is worth $200,000. And it's a neighborhood. There are many other people as well in my neighborhood who have their own properties. I purchased it at $200,000 and now I need to sell it. After 10 years, I want to sell it. It's been 10 years ago that I invested this much amount. Now today I want to sell it. At what rate will I sell it? What would be the rate or factor that I would consider to determine my selling price? This is my cost price. What is my selling price? 10 years later, okay? This was 10 years ago. Today, I want to sell it. What should be the amount that I should charge? Current market value. Okay. But why don't I go for that discount rate or, the market rate of returns? Let's say I try to correlate with the government T-bill rates and so on. Current market return, current market value, opportunity cost. What exactly is here? The story. Although I purchased it at $200,000, I would definitely want to get the best value for my real estate or my property. So the best way I can figure out is, okay, probably another property in my neighborhood was sold for $500,000. Or let's say not $500,000, it was sold for $800,000. And the property specifications in terms of dimensions, size, everything is exactly the same. The upkeep, everything is in good condition. So their property was sold for $800,000. Now, if I were to stick to those traditional rate of returns, T-bill rates, I don't think I can get $800,000. Probably, after doing all the glorious valuation approaches, methods, I can at the most get $500,000. Is it wise enough to sell it at $500,000 just because my valuation techniques or the methods which technically are called to be the perfect method is giving me the valuation of $500,000? Will I sell it at $500,000 or sell it at $800,000 because my my neighbor sold it for $800,000? Of course, I would want to get the best. So that's $800,000. I would definitely not look at this. Now, the question is, what about those amazing terms, valuation, all these things that we have done? Where did that go? It's opportunity cost. Someone has just mentioned it correctly. It's opportunity cost. $500,000. I could have done that, okay? But by not selling at $800,000, this is the opportunity that I'm getting, okay? $800,000 is the opportunity which I'm getting to sell it. By not selling at $800,000, ideally, a simple human expectations, you would want to sell it either at the same amount or higher. You definitely don't want to sell it for lesser amount because that's the market at which it's trading. If someone comes up and says, I'll pay you $900,000, you would be even more happy. You expected $800,000. Someone give you additional 100,000. Okay. Now, in this case, 800,000 becomes your opportunity cost. 800,000 becomes your opportunity cost. So whoever comes to you to purchase your property, you tell them, look, there is already someone who has sold your property for $800,000. I'm very confident even my property would be sold for that, the same amount. If you can give me this much, I will consider your offer. If you can give me better deal, like let's say $900,000 or so, I would sell it to you. Otherwise, don't bother me. That means I am creating an opportunity cost over here for myself. This is it. Okay.